Welcome to FM with Sir Evans. In today's session, we will discuss the fifth competency in the syllabus of ICA Paper 2.4, Financial Management. Let's get started. The Treasury Management function deals with the management of monetary assets and liabilities, particularly cash and financial risk. Areas include cash management and liquidity management, banking relationship, obtaining short-term and long-term funding, financial forecasting and planning, managing interest rate risk and currency risk, and possibly also commodity risk, and management of financial investment. So we'll look at each of these areas one after the other. So the first one, cash management and liquidity management. The cash management role of Treasury is to centralize the control of cash, to make sure cash is efficiently used, surplus used to fund any shortfalls, and every surplus is also invested. Information about bank balances, receipts, and payments can be monitored, often via online banking arrangements. And liquidity management monitors the cash position of organization to make sure that cash will be available when required to meet payment obligations. If there are any shortfalls, then measures will be taken to make sure that cash is available, and where there is a surplus, is going to be used until it is needed. Cash flow forecasting is when we put measures in place to establish whether the organization is expecting to have a cash surplus or is going to be short of cash. So cash budgets for short-term forecasts and expected cash flow statements for longer-term cash forecasts are prepared. Now, working capital management is the management of the movement in inventory, trade debtors, and trade payables on the cash position. And then when it comes to managing bank accounts, we are referring to the instance of pooling cash so that balances on different bank accounts are all treated as one single balance. So money from positive accounts will be moved to almost deficit accounts to minimize any interest payments on overdrawn accounts. An in-house bank is where subsidiaries of multinationals are required to borrow from an in-house bank managed by the Treasury function. So borrowing for the group is then arranged. So these are the Treasury Management function under cash management and liquidity management. So the second one is managing banking relationship. So this is where the head of the Treasury Management is likely to have the responsibility for maintaining good relationship with the company's bank. So the bank must be assured of the credit worthiness of the company. Credit rating determines the cost of borrowing and interest rate charged. So fees and interest rates will often be negotiated. Obtaining long-term and short-term finance. So for long-term investments, there should be long-term finance, such as equity or debt, or even leasing. And for debt or securities or bonds, they can be issued to investors. And then for short-term investments, a combination of long and short-term finance is obtained. Main sources of equity are retained profits and then the issue of new shares. Financial risk management. So some risks include foreign exchange or currency risk, when transactions are in foreign currency or value of local currency changes over time. Interest rate risk, which is where there are unexpected changes in interest rate. Commodity risk, which is the risk of movement in prices of commodity. Market risk, which is the movement in market price of shares or bonds. So these are all managed by the Treasury function. Financial forecast and planning. So budgets will be compared to actual. Then we look out for the various periods to assist in identifying the causes of variances. This will then assist the Treasury Management team to make financial forecasts and plans. Then the last one is managing financial investment. So temporary surplus funds will be invested in expectation of making a return in the form of interest, profit, or a capital gain. So all investments carry some form of risk, and this may lead to higher or lower returns than expected. As a general rule, low-risk investments are going to yield a relatively low return, and higher risk investment yield high return. The Treasury Department is going to manage the company's portfolio of financial instruments to ensure that the returns are obtained with perceived risk at the acceptable level. Now, the culture and value of a particular company can be expressed in terms of the risk appetite. So companies with high risk culture will try to maximize whatever profit and return over the short term and take high risks to get those returns, while conservative companies will seek to keep risk within the acceptable level and take longer term view of growth and returns. So treasury management is concerned with the financial risk and their management based on culture and values of the company. So we'll be looking at some of the risks which are faced by the entity. So the first one we'll look at is the currency risk. So this affects individual trading and borrowing of companies and applies to global finance markets generally. They can influence the economic and business conditions worldwide. For instance, when there is a high US dollar exchange rate, it hinders borrowing from such countries. Interest risk. This affects individual company transactions with global implications. So when the global economy is strong and inflation rate is increasing, major central banks are going to raise interest rates to subdue demand in the economy and restrain the rate of price increases. When global economy is weak, interest rates are kept low to stimulate demand and restrain any decrease of price. Liquidity risk. This is risk of having insufficient liquidity and being unable to obtain sufficient cash when it is needed. So it leads to low market activity and investments will fall. Higher yields may be offered to attract investments in these instances. And credit risk. It is the risk of default on a debt that may arise from a borrower failing to make required payments. Credit risk management is not usually the responsibility of the treasury management function. This, however, can have global implications when a large number of debtors fail to meet their debt obligation. If interest risk unexpectedly by a large amount, many borrowers are going to default when these interest rates rise unexpectedly. Now, at this point, we'll look at the market volatility. It's a measure of the extent to which price of financial security, example, share price, market interest rates, currency or commodity, changes over time. So high volatility means that there is rapid and large changes in a price or rate over a short period of time, while low volatility means that there is smaller and less frequent price change. So volatility refers to price movement in both directions and not the same direction. So it implies uncertainty about the way that prices will move next and by how much. So high volatility creates high financial risk and investors will prefer higher return in such instances. Now we look at bull and bear markets. So they describe markets where price movements are generally always in the same direction, either up or down. So for bull markets, prices on the whole move upwards continually over time. It eventually comes to an end when price stabilizes. For bear markets, prices on the whole move downwards continually over time and also ends when price stabilizes. So investors are likely to invest in bull markets and withdraw their investments in a bear market. Now, to understand some of the dynamics and trends and to monitor key financial market indices, there are certain financial markets which you can look out for. So we have the Ghana Commodity Exchange, Ghana Stock Exchange Index. So the Ghana Stock Exchange Index rises indicate likely economic growth. We have the Government of Ghana Treasury Yields, inflation rates, which are measured by Consumer Price Index, and currency exchange value of CD against the US dollar, among others. All of these are able to tell the uncertainties in the market and the movement of the various financial indicators. Okay, companies who enter into transactions in a foreign currency often requires foreign exchange for international trade and investment. So many foreign currencies can be bought and sold freely in the foreign exchange markets, which are operated by banks. So with this point, we are going to look at the various foreign exchange rates and the differences among them. So the first one we'll take is spot rate versus forward rate. So a spot rate is for sale of one currency in exchange for another for immediate settlement. That is after 2 working days. while a forward rate is where currency is bought and sold at a pre-agreed future date, at a pre-agreed rate as a means of reducing risk. So whereas spot rates happen immediately, forward rates happen after a period of time. And exchange rate is the price of one currency in terms of another, where price refers to that of the foreign currency being sold. So we have direct quotes and indirect quotes. So direct quotes is the number of units of domestic currency that will be exchanged for 1 unit of a foreign currency. Example, 6 cedis to $1 is a direct quote if you are in Ghana. If you are in the US, then $1 to 6 Ghana cedis becomes a direct quote. But if you are in Ghana, 1 Ghana cedi to $0.17 is an indirect quote. So depending on where you are, then you determine whether it's a direct quote or an indirect quote. So a direct quote is the number of units of domestic currency that will be exchanged for 1 unit of a foreign currency, whereas an indirect quote is the number of units of foreign currency that will be traded for 1 unit of domestic currency. So a direct quote of one currency is indirect quote of the other, and the reciprocal of the direct gives an indirect quote. Now, strong and weak rates. As one currency strengthens, the other weakens. So for example, one pound making $1.5, if it moves to 1 pound making $1.6, then what we are saying is that the pound is becoming stronger because we need more dollars to be able to get same 1 pound. So from $1.5 moving to $1.6, then obviously the pound is becoming stronger and stronger. And the reverse is also true. So for weak rates, example, 4.5 Ghana cedis making $1. If it moves to 5.5 Ghana cedi making $1, it means that the Ghanaian cedi is becoming weak because over time we need more Ghana cedis to get the same $1 that we would have gotten. Now, bid and offer prices. So bid rate is the rate at which the bank will buy the foreign currency. So this is often the weaker rate for the currency, whereas offer rate is the rate at which the bank will sell the foreign currency. And this is the stronger rate for the currency. So banks sell at a stronger rate and they buy at a weaker rate. The bank will always make a gain. So most exchange rates are also quoted to 4 decimal places. So we'll look at some examples. So a Ghanaian company needs $10,000 to pay a US supplier. The bank's current rates for cedi US dollar are 4.8 to 5.2, being equivalent to $1. So at this point, let's identify, is this a direct quote or an indirect quote? So this is a direct quote because we are looking at the number of the local currency giving one of the foreign currency. So the company needs to buy US dollars in exchange for cedi. And in order to pay the US supplier, how much would the bank buy and sell? So the Ghanaian company needs $10,000. So right now, the Ghanaian company is going to the bank to go and buy the dollars. And you should know that the bank is going to sell to the Ghanaian company at the higher rate, So if you just want to be sure, so to do your conversion also, it's going to be a matter of change of subjects. So if $1 is equivalent to 4.8 cedis, how many would $10,000 be? So that's going to be simply you multiplying the 10,000 by the particular rate. So 10,000 by 4.8 gives you a particular amount of dollars, and 10,000 by the 5.2 gives you a particular amount of dollars. So the bank will sell to the company at the higher. So 10,000 and 4.8 gives you about 48,000, and 5.2 times 10,000 gives you 52,000. So obviously the bank is going to sell to the company at the higher, which is the 52,000. Okay, let's look at another example. A UK company needs $10,000 to pay a US supplier. A UK company, they need $10,000 to pay a US supplier. The bank's current rate for sterling US dollar is 1 pound is equivalent to 1.5 US dollar to 1.6 US dollar. So there is a bid rate there as well. And then there is an ask rate and a bid rate. So you look for the one which is going to give the bank more return, which is going to give the bank more return. So for instance, $10,000, if you want to do the conversion, then it's going to be $1.5 equivalent to £1. Then $10,000 is going to be what? So that's going to be 10,000 divided by the 1.5. So 10,000 divided by 1.5, giving you how many pounds? 10,000 divided by 1.6, giving you how many pounds? So when you do that conversion, then you select the one with the highest amount, because that is what the bank is going to sell. So when you do it, obviously 10,000 divided by 1.5 gives you the 6,667 pounds, which is the highest. So what that means is that the first example, the Ghanaian company, it was quoted in the direct quotes. But then the second one, it was quoted in the indirect quote. So where is quoted in the direct quote, the bank will go for the highest amount. Where is quoted in the indirect quote, the bank will go for the lowest one, because you are going to do a division there, and dividing by the lowest gives you the higher at the end of the day. So let's look at a last example. So a French company has received 70,000 Australian dollars from a customer. So this is a French company receiving 70,000 Australian dollars. And the current exchange rate for the euro and the Australian dollar is 1 euro being equivalent to 1.523 Australian dollars and 1.5240 Australian dollars. So how much would the company receive in euros for selling the Australian dollars? So first of all, is this a direct quote or an indirect quote? So because we are looking at a French company, then the rate there is also looking at one of the local, giving you how many of the foreign. So these are indirect quotes. So that's first of all. And then what situation is happening here? Is a company going to buy or is going to sell? Now the company has 70,000 Australian dollars. And he is going to sell these Australian dollars. So the bank will do what? The bank will buy. The bank will buy. So the bank will often buy at the lower amount. So as I mentioned, if it's an indirect quote, we are looking for, if you pick the lowest within the range, then you are going to get the highest. If you pick the highest, you are going to get the lowest. So 70,000 Australian dollars divided by 1.523 and 70,000 divided by 1.524, which of them is going to give you the lowest? Is going to be the 1.524. So 70,000 divided by 1.524 is the amount at which the bank is going to buy these Australian dollars. Okay, so exchange rate volatility is where the rates move up or down by a large amount within a fairly short period of time. So exchange rate volatility creates foreign exchange rates for anyone who is involved in the buying, selling, borrowing, or investing in foreign currency. So some of the risks involved are: one, we have the translation risk. So it's the risk of losses or gains arising on the translation of financial statements of a foreign subsidiary into the currency of the parent company. So for the purpose of preparing consolidated accounts, that's translation risk. Economic risk, it refers to the long-term movement in exchange rates caused by changes in the competitiveness of a country. So economic risk in the context of foreign exchange is therefore the risk that a company must choose to locate its operations in a country whose currency gains in value over time against the currencies of its competitors in world markets. So the consequences of an increase in the value of the domestic currency is a loss of competitiveness. And then the third one is the transaction risk. So transaction risk is a foreign exchange risk that arises in transaction between two parties, where normal transaction currency of each party is different, and then where transaction involves future receipts or payment between the two parties. So transaction risk is the risk that for any future transaction in a foreign currency, the amount received or paid in domestic currency might be different from the amount originally expected because of movements in exchange rates between the date of the initial transaction and the date of settlement, that's the payment or receipt. So volatile exchange rate increases transaction risk, and the transaction loss might even offset the amount of normal trading profit that we are expecting from whatever business we go into. So those are the three foreign exchange rates posed to the entity: translation risk, economic risk, transaction risk. So we'll take an example. A Ghanaian company sells cocoa paste to a US buyer for 100,000 US dollars, and the exchange rate is 5.2 cedis, equivalent to $1. So first of all, what is this one? It's a Ghanaian company. So this is a direct quote. Therefore, the Ghanaian company expects to receive 520,000 Ghana cedis, and the US buyer is allowed 3 months credit. So after 3 months, the Ghanaian company receives $100,000 from the US buyer, and the rate is then 5 Ghana cedi to 1. Therefore, the Ghanaian company received 500,000. So he was expecting 520, but because the exchange rate has moved from 5.2 being $1 to 5 cedi being $1, we are looking at a situation where the Ghana cedi is becoming stronger because we are requiring lesser and lesser Ghana cedis to get the same dollars. So therefore, the company is going to receive 500,000 Ghana cedis. So that means that there is an exchange loss of 20,000 being made there. However, after 3 months, if the rate is 5.4 to $1, what does that mean? That means that the Ghana cedi is becoming weaker. Then the company is going to receive 540,000 Ghana cedis. And these 540,000 Ghana cedi being received is equivalent to a gain of 20,000. So this example illustrates several points about transaction risk. So we'll look at each of these ones. So the first one, currency risk arises from exposure to the consequences of a rise or fall in an exchange rate. So here the Ghanaian company was exposed to the risk of a fall in the value of the US dollar. Transaction risk arises only when the settlement of transaction, and that is receipt and payment, will occur at a future date. And exchange differences only occurs in the above circumstances where there is a movement in the exchange rate. So if the exchange rate has stayed the same, there wouldn't have been any transaction risk. But because it moves, then there was a transaction risk. And an exposure lies for a period of time. Here, the exposure lasts from when the goods were sold on credit until the time that the customer eventually pays. So currency risk is a two-way risk. And exposure to risk can lead to either losses or gains from movement in an exchange rate. So in the above example, you can see that the exchange rate could have moved the other way. Trading profit for companies engaged in foreign trade can significantly be affected by these currency movements. So when exchange rates are volatile and unpredictable, the gain or loss on currency exchange could possibly be even bigger than the expected gross profit for the transaction. So in the example above, the Ghanaian company operated on a 10% margin. The transaction risk means that a company could be worse off, that is downside risk, or better off, upside risk, depending on the way the exchange rates move. So let's look at how we would be able to reduce or avoid such risk. So first of all, we have own currency. So the easiest way to avoid foreign currency transaction exposure is to simply invoice or be invoiced in your own currency. So this passes the exchange risk over to the customer or supplier. So customers might favor a supplier who is willing to invoice the customer in the customer's own currency. However, some goods are denominated in a particular currency. Example is oil. Hedging. So these are the variety of techniques which are used in removing or reducing volatility. So most results in the company missing out on exchange gains in order to protect themselves from exchange losses. So some of the summaries of currency risk we've looked at is one, the translation risk. This does not affect the cash flow of a group of companies. It is the risk of non-cash losses or gains in consolidation. And if you remember, translation risk is when you are translating a subsidiary's accounts into a particular currency where you will be used to report, to do your consolidated reporting. Transaction risk. This risk affects amounts received or paid, hence it affects the cash flow. And economic risk is a strategic risk, and it affects the competitiveness of a business over a longer term. Forward rate. forward rates and what is forward contract? So forward rate is a rate at which a bank is willing to trade in foreign currency at a pre-agreed date. So banks are able to quote forward exchange rates for currencies because of the money markets. That's the short-term borrowing and lending markets. So they differ from spot rates. Forward rate differ from spot rate because of the interest rate differences between the two currencies. So a forward rate could be stronger or a weaker rate than the spot rate, depending on whether the interest rate on the variable currency is at a premium or discount to the spot rate. So we first start from the spot rate, then we look at any premium or discount, then we arrive at the forward rate. A forward exchange contract is a contract between a customer and a bank for the purchase or sale of a specified amount, specified foreign currency for a delivery at a specified future date and at a specified rate. So the customer will specify the amount of foreign currency and the date, and the bank will specify the rate at which it is willing to deal. They are normally for settlement in one month, 3 months, 6 months, or even possibly 1 year. Now, what are the premium and discounts that we looked at? So forward rates are quoted as adjustment to the spot rate and might be premium, that is PM, and where the rate is stronger than the spot rate. So where the rate is stronger than the spot rate, then it's going to be quoted at a premium PM, or it's going to be quoted at a discount where the future rate is weaker. So the nature of adjustment to the spot rate often depends on whether the quotes are direct or indirect. So where the quote is direct and you are quoting your forward rate at a premium to the spot, then you add a premium. If it's at a discount, then you deduct the discount. That's for direct quotes. For direct quotes, we add premium, we deduct discount. And for indirect quotes, we deduct premium, we add discount. So what do I mean by this? So let's look at an example here. So direct quotes, we first start from the spot rate. And in the second column, we see that the foreign currency is trading at a premium. So just to remind ourselves, if it's direct quote, we add premium, we deduct discount. If it's an indirect quote, we deduct premium, we add discount. So the second column is where the foreign currency is trading at a premium. The second column is at a discount. So we have spot rate of 5 cedi to $1, 5 cedi to $1. If it's a premium, this is a direct quote. So if it's a premium of 0.2 cedis, then what we are doing is that we are adding the premium. Therefore, our forward rate becomes 5.2 cedis to $1. But if it's a discount, the discount is 0.2 cedis, so we deduct the discount. So it becomes 4.8 to $1. Forward contracts and hedging exposure to forex rates. So forward contracts can be used to hedge an exposure to currency risk, which may be due to changes in the exchange rate. So the currency could either be strengthened or it could be weakened. So let's look at an example. So a US company needs to pay a Mexican supplier in 3 months. It will have to pay the supplier 10 million Mexican pesos. The company wants to arrange a forward contract to hedge its risk exposure. So a bank quotes the following rates, that is $1 to a number of pesos. So we have $1 to 11.247 to 11.2485 pesos. So this is a US company, So meaning this is an indirect quote because it's going to, the quote is in $1 being equivalent to a number of pesos. So this is an indirect quote. So first, we always need to identify what is the company, where is the company located, and the rates that are being quoted, are they indirect or indirect? And that's where you start from. So in this instance, it's a US company, and then the rate is quoted at $1 to a number of pesos. So this is an indirect quote. So the 3-month forward is going to be 340 to 360 discount. So this is a discount. So we remember that if it's an indirect quote, where it is a discount, we are going to, if it's an indirect quote, we are going to deduct the premium and we add the discount. We deduct the premium and add the discount. So our job here now is to use using a forward contract. What will it cost the US company in dollars to pay the Mexican supplier in 3 months' time? So we are determining the forward. So we know that if it's an indirect, we are going to add a discount. So our job here is to identify which of the spot rates are we using and which of the discounts are we going to use. So this is an indirect quote. And then the US company needs the Mexican supplier. It means that the bank is going to sell to the US company, and the bank will sell at the highest. So to sell at the highest, they are obviously going to choose the 11.2470. And then that would also go with the discount of 340, which is going to be 0.0340. So you add 11.47 plus your discount, and that gives you 11.281. And that is what you use in translating your 10 million Mexican pesos to your US dollars to give you 886,446.24. Okay, another example. A UK company expects to receive 75 US dollars in 6 months. So the UK company is expecting to receive in 6 months from a US customer, and it wishes to hedge the exposure to currency risk by arranging a forward contract. So the following rates are available. We have £1 to a US dollar of 1.7530 to 1.7540. So which kind of quote is this? Is it direct or indirect? So this is a UK company. And a UK company, the original currency is pounds. But here it is quoted as £1 to a number of US dollars. So this is also an indirect quote. And then the 6 month forward is arranged by a premium. We see PM there, by a premium. So where is an indirect quote? What do you do for indirect quotes? We deduct the premium, we add the discount. For direct quotes, we add the premium, deduct the discount. This instance is an indirect quote, and we are having a premium, so we are going to deduct. So our job is to find out which of the spot rates to use and its equivalent premium. So the company is going to have 75,000 US dollars, meaning it's going to give that 75,000 US dollars to the bank, and the bank is going to buy it, and the bank will buy it at the lower. So the company is the one having the US dollars and is going to give it to the bank, and the bank will buy it at the lower. So between 7.530 and 1.7540, obviously the 1.7540 is going to give you the lower, because you are going to do a division there. So the spot rate becomes 1.7540, and the forward point becomes 0.0231, and therefore your forward rate is 1.7309. So the company can use a forward contract to fix its future income from the US dollar at 43,330.06 pounds. That's 75,000 divided by our forward rate of 1.7309. So as I said, the dollar is quoted forward at a premium. The premium is shown in points of price. So 240 to 231 means 0.0240 to 0.0231. And the bank will apply the rate that is more favorable to itself. So you can use each of the rates to check, as I initially said, and the company will be selling the US dollar in exchange for pounds, and the higher rate is used. So thank you very much for staying with me to this point. Kindly follow the link below to join the channel for the paper, that's the financial management paper, where you can have access to the slides I just presented, the marking scheme to the various examples I discussed in the session, and other relevant materials to aid your preparation. Thank you once again, and see you in the next session.